I give you $10,000 right now, and the only thing you could do with it was invest it. Would you put all $10,000 in the stock market right away, or would you spread it out over a period of time? Whatever you decide is your investing strategy, and that's what we're going to be talking about today. Hi everyone, welcome to my channel. My name is Reni. If you're new here, welcome, and if you're a returning subscriber, welcome back. On my channel, I make content about financial literacy, career development, and lifestyle. So if any of those topics interest you, feel free to hit that subscribe button down below so you can see more of my content. Today we're going to be talking about something called dollar cost averaging. This is the investment strategy that I have been using for the past 7 years of me investing, and it's done pretty well for me, so I want to tell all of you about it. Dollar cost averaging is actually a tactic that many of us actually already use, but you probably don't even know that you're using it. So what is dollar cost averaging? Dollar cost averaging is a investment strategy where you systematically invest in equal amounts over a specific interval of time, regardless of the price of whatever you're buying. That may seem like a complicated definition, but I'm going to explain it and break it down for you. So I always say, and experts always say, that time in the market is better than trying to time the market, which essentially means that, okay, everybody wants to try and buy low and sell high, and that's always the goal. But the reality is, nobody knows when the market will be low and nobody knows when the market will be high. If we all knew that the market would be low at a certain point, then we would all buy then, of course, and then everyone would be a billionaire. But unfortunately, we do not know this. But what we do know is that the market over the past however many hundred years has continuously gone up and up and up. It's trended up overall. So with that knowledge, instead of trying to buy at a super low point and try to time it and see, okay, I'm waiting for the market to crash and then I'm gonna buy, instead of trying to do that, instead you can regularly invest in the stock market, and that is exactly what I do. So let me give you a practical example. I was 18 years old when I started investing, and again, back at that time, I think I was maybe 19 when I started investing in Shopify, or maybe 20 years old, and I was making not that much. I was making $9 an hour, but Shopify was a company that my dad identified, and he said, this is gonna be the next big thing. And I was like, okay, Dad, you know everything, let me put my money in Shopify. This is not financial advice, by the way, but I listened to him and I was like, okay, I was working a $9 an hour job, so I didn't have that much money, but my dad was like, it doesn't matter if you don't have a lot of money, you can simply drip in the market. Every 2 weeks that you get paid, put a little bit of money into Shopify or whatever stock that you're buying. So that's what I did. Every 2 weeks, I would put $200 or so, $230, so however many dollars, and buy Shopify, and buy Shopify, and buy Shopify. Whether the price was up, some days it was $190, some days it was $210. Whatever the price was, I was buying that stock. And this is exactly what dollar cost averaging is. No matter what the price of the asset is, whether it's up one day or down one day, I'm going to buy that stock at whatever the price is, because I'm trying to get in the market. I'm not trying to time the market, I'm just trying to get in the market and then hold and hold and hold. So when you do what I did, you are employing the tactic of dollar cost averaging. And of course, when the market is high, that means you are going to be buying things at a higher price, meaning you can buy less of them. Whereas if the market is low, then it's on sale and you're able to buy more of them. So let's use a practical example. If I have, say, $100 to spend every single week, and the stock that I want to buy, or the ETF, or whatever I'm trying to buy, is $10, if the price of the asset is $10 this week, I can buy 10 of them. So 10 times 10, I can buy 10 of them. Say the market goes down and now the stock costs $5. Now I can buy 20 of those shares for that $100. And if the market was up, say the stock went to $20, now I can buy 5 of those shares for that same $100. So as you can see, I'm still buying the same asset, or the same security is what I'll call it, the same ETF, the same whatever stock. However, I am able to buy less some days and I'm able to buy more some days. So the average price of the assets that I bought is $10. Even though I bought some at $5, I bought some at $20, the average price is $10. And you may be asking, okay, why don't you just buy at $5? Like, why are you buying at $10 and $20? Why don't you just wait for it to crash? Again, the reality is you don't know if it will crash or not. There's no guarantee that it will crash. So you could be at that $10 mark and be waiting for it to crash to $5, but it just keeps climbing up and up and up. So you're waiting for it to fall. You're just missing your time in the market. You're missing holding on to that asset that's growing because you're waiting for it to fall. So that's why I like to eliminate the guesswork, eliminate my emotions out of it, stop trying to time the market, and instead I just buy. No matter what the price, I'm buying the stock. So we are gonna look at the stock Microsoft and then see how this would play in action. So I'm gonna look at Microsoft over the past 1 year. The price of Microsoft at this time last year was $228 US. The price right now is $280.27. So obviously, the best thing that I could have possibly done was buy it at the lowest point throughout these past 52 weeks, which was actually $224. That was the lowest price in the past 52 weeks. However, again, it's not realistic for you to know exactly when the lowest price was. But if I was continuously trying to time it, like, okay, I'm waiting for the lowest price, I'm waiting for the lowest price, I'm waiting for the lowest price, I would actually miss it. So what I do instead is every 2 weeks when I get paid on my bi-weekly paycheck, I will put however much I have, $1,000 into Microsoft stocks every 2 weeks, $500, $200, whatever I can afford into buying the Microsoft stocks every 2 weeks. You can see the growth over time. So you can see that the market is pretty volatile. Every day it's moving up and down. Every second it's moving up and down. But by dollar cost averaging, you actually get to avoid all of these ups and downs because you are just getting the average of all of these gains, right? And you can think of it as like this. If I were to have bought Microsoft at 341, I was like, okay, I just got a refund. I just got a bonus at work. It's December. I just got a huge bonus at work. Let me put all $10,000 into Microsoft. And you bought it at $341, then imagine right now what your portfolio would be looking like. It would be looking very red. Whereas if you bought on a dollar cost average basis every 2 weeks, your overall average would be much lower than that $349. So let's get into the pros and cons of dollar cost averaging. One of the pros of dollar cost averaging is that if the stock price decreases, then your average price per share is decreasing. Again, as I just gave you with that Microsoft example, if the price was $340 this day that I bought it at first, and then 2 weeks later it's $310, my whole price of all the stocks I have are not at $340. They're somewhere in between the $340 to $310 to $349 range, which means that the average price per share is lower. Obviously, this benefits you in a market that's currently going down. And then on the flip side, obviously, if the price is going up, so say that the price is just increasing slowly every 2 weeks as you're buying, then obviously your average price per share is a bit higher. To me, it's not a big deal, but obviously if you knew and you had a crystal ball, you could have put all the lump sum in at the lower price, and then you got all the gains because the price is increasing. The second pro that I would say about dollar cost averaging is that you feel psychologically safer in this situation simply because with me, I take all the emotions out of it. I put in that money every 2 weeks, and I'm not even thinking about like, oh my gosh, the stock's so high, oh my gosh, like I'm not trying to time the market. I believe in this company and I'm putting the money in every 2 weeks. It's not a guessing game. It's not like I'm emotionally tied to this purchase. I know that whatever the price is, I'm buying a solid company that I know has a good long-term prospects, so it doesn't really matter when I put the money in as long as I'm holding it for the long term. So I think it makes me feel calmer. So even if the market is crashing, I'm not mad because it's like, ooh, the stuff is on sale. And when the market is increasing, you know, you're happy about it. So I like this just because it makes me feel emotionally, you know, I'm able to take my emotions out of it compared to if I put a whole lump sum of money into a stock and then the market crashes right after that. That would be a little bit devastating. The third pro of dollar cost averaging is simply that it is a bit more realistic for people. Most people don't have $10,000 to just dump into the market. So most people, as I said earlier, most people are actually dollar cost averaging. They just don't know they are. They're putting money on a bi-weekly basis into the market or however often that they can, and they are purchasing stocks. One more con that I will say about dollar cost averaging is that you can incur trading costs. And it depends on the platform that you use. These days, with a lot of commission-free platforms, it's not a big deal. So if you use Wealthsimple, for example, then you're not actually incurring trading costs. So it doesn't actually matter how often you're going to be buying securities because you're not incurring trading costs. So if you want to sign up for Wealthsimple, I am an affiliate, so feel free to use my code down below and you'll get $50 free. But if you use a platform like TD, for example, TD charges $9.99 per transaction. So if I were to buy, if I had $5,000 and I say, okay, I'm going to spread this over the next 5 weeks and I'm going to put in money every week. Across those 5 weeks, you're going to be paying $10, $10, $10, $10 each time. That's an additional $40 that you wouldn't have had to pay if you had done a lump sum. So that is a difference. So if you do need to be careful of that, which is why if you are investing small amounts of money, I typically recommend using like a free platform like Wealthsimple or Questrade, one of those two. Lastly, let's talk about how you dollar cost average. Again, there are very simple ways. The first thing that you need to do is research what you're going to invest in. And then the next thing you would do would be actually to invest in it. Go to your brokerage account and actually put the money into the stock. I feel like a lot of people, they buy a stock once and then they just hold and hold and hold and hold forever. The next step that you need to do after you invest is to actually set up a recurring contribution so that you're constantly investing into the stock market. For a lot of platforms, you have to do this manually, but there are also options to do this automatically. I would suggest at least automating the transfer into your account. So I know that every 2 weeks, this amount of money is going to be transferred into my investing account. But then I actually have to, with TD, I actually have to buy something with I actually have to do the purchase myself. It won't automatically buy it for me. Whereas if I'm using Wealthsimple Invest, which is a robo-advisor, it takes the money out of my account and it automatically invests it for me. So there are two options, but whatever you do, set up that recurring transfer so that on a regular basis, every time you get paid, the money is out of your checking account into your investing account, and then you are investing it every 2 weeks. So let me know, which strategy are you going to employ? Are you going to do a lump sum investment, or are you going to do dollar cost averaging? Of course, there are pros and cons of each, as I said. There's no like, this is not perfect, you know, neither one is perfect. As long as you're investing, I think that is the most important thing. Again, I prefer to do dollar cost averaging, and then sometimes, you know, if I get a little extra money, I'm going to put a little extra money into a stock. But to me, dollar cost averaging is safe, and it's worked pretty well for me so far. So I hope you like this video. I hope this explained very clearly and easily what dollar cost averaging is. If you have any questions about it, feel free to leave them down below. If you like this kind of content, feel free to hit that like button because it lets me know that you want more videos like this. If you don't like it, don't like it, but if you do like it, please hit that like button as I use this as a gauge to see which videos I'm going to keep doing and which videos I'm not going to do. So thank you so much for watching. I hope you enjoyed, and I'll see you in the next one. Bye!